Hi there. So we're in the last week of February, and let's first look at our regular numbers on how did Nifty perform, and then we'll check out the latest GDP numbers and what they have to tell about progress in India. So Nifty kind of as expected traded sideways, but initially a little bit of downtrend, and then with GDP numbers coming in, it consolidated back and it ended up 0.57% up. So, definitely a good week again for Nifty. And in terms of advances, we had 32 advances, 18 declines, and foreign institutions bought like they almost remained stable, and it was neither buy nor sell 24 CR, and DIs continue to buy at 8,266 crores. So, coming to our regular topic, that's from the week, that's like quote from the week: don't look for the needle in the haystack, but just buy the haystack. So what it means is that if there is growth, typically the growth is across. So if you are trying to look for something which is just awesome, and missing out on the overall growth, then you're going to miss out. So if you believe in the India story, then just buy the India story in terms of either ETFs or picking up the right stocks, but don't overanalyze and don't try to just spread yourself too thin or not invest because you're trying to over optimize. That's the prime thing that John Bogle has to say about it. Now, in terms of the sectors and focus, metals up by 2.87%, auto up by 1.74, and media continued its downtrend, especially after the Z Sony merger fall off, which happened previous week, but this week it was confirmed, so it was down by 5.56%. Now, GDP data came, the numbers are obviously very positive, and you would have heard about it. We tried analyzing it further and then coming up with what are the key takeaways and what you should be cautious about, what you should be looking at. So let's just look at what the numbers tell from GDP perspective first. So in terms of numbers, as you would have already heard, there's growth of 8.4%, whereas analysts were expecting it to be around 6.6%. Investment growth at 10.6%, which is significant, and it shows tremendous confidence in the economy. For the FY24 estimates, the numbers have been revised to be 7.6% compared to 7.3%. And if you look at sector wise breakdown, manufacturing growth around 11.6%, construction 9.5%, and mining around 7.5%. So all numbers looking good on this front. But the sector which disappointed was primarily the agriculture, which also happens to be something which is impacts a huge population in the country, and all said and done we are still an agriculture economy. So it only grew by 0.7%, which means that uh, the disposable income in the rural India is not increasing. Thereby, overall purchasing power is expected to remain low. So it remained at 0.7%. And if you really look at, the consumption has only increased by 3.5%. Uh, so if the numbers indicate that there was overall GDP growth of 8.5%, then ideally we should have been around 7.5% of the consumption growth too. But which does indicate that there is a significant difference in terms of the value being added and the actual GDP. So if you really look at it, the overall gross value being added is GDP plus subsidies minus taxes on products. So a lot of what we are seeing as growth is coming because of the taxes on products and the subsidies being reduced. So ideally this gap should not be that high as in between GVA and GDP. But since the subsidies are getting reduced and the taxes on products, especially in this quarter, have been significantly high, the gross value added is at 6.5%, which is not a significant growth from what was anticipated. Most of the growth is coming from the fact that there is higher tax, indirect taxes that have come into the framework. Now, what are the key takeaways for us? Primarily, if we look at GDP, it is based on two factors. One is the government expenditure, and the other is the private investment and consumption. So, if we really look at private consumption, it has stood at 3.5%, whereas the overall GDP growth is at 8.5%, which means majority of the growth is coming from government spending. And since this is coming from the government spending, it also means that, one is of course the is increasing, and overall tax collections are showing very positive trend. But still, in terms of the fact that most of the government spending is coming because of the infrastructure investment, which has been also allocated for more in the budget, it's also adding to the fiscal deficit, which government wants to cut down. So, in the process, what it means is that a lot of growth is coming from the government in expenditure, and that is adding to the fiscal deficit. So, overall, although the numbers are looking great, but since it is coming from government expenditure, it is going to not sustain itself until as the private consumption increases. The overall GDP growth at this level will not be sustainable. That's the key point. Now, obviously, the idea over here being that if the Nifty jumped 1.6% on the back of these GDP numbers, should you be really blindly investing? Yes, there's optimism in the air, and there's a fact that government plans to invest more, and there will be growth. But until unless there is growth in the sectors like agriculture and there is overall growth in the private consumption, these numbers are not sustainable, and they are just indicating a positive trend and the confidence in the economy. So hopefully the next cycle we see a uptrend in the private consumption, as well as some of the sectors start improving and the confidence builds in the GDP numbers. But for now, stay cautious and try and understand that there's some sectors which are expected to do well over a period of time, and if they are offered to you at reasonable valuations, then make an investment over there. And that's what we are trying to do at this point in time. But the fact is that some of the sectors have become overvalued. So we will be tracking it, and as and when we build positions based upon those understandings and assumptions, we'll be sharing it. So for now, stay invested, stay cautious, and look for the opportunities on the downtrends. So that's the key takeaway for this week. I'll see you in the next week, wherein we cover another set of major news. And primarily, our objective of having this channel is to go deeper with numbers, try and understand the macroeconomic trends, see how a particular industry is trending, and then identify stocks based on numbers. So I'll see you in the next one, and stay invested till then. Bye.